Yeah, it's streaming live on Facebook.
Here we go. This should be, streaming to the Facebook group.
Guess we can give it a minute or two, or
Yeah, give it a minute. What's up, Justin?
What's up?
in the group. Can I share it? Yeah.
What's that?
Trying to see if I can share it on Facebook. Since it's in the group, it doesn't allow me to.
Oh, like to your personal page versus a group page? So I've got this, I've got it set up to any of us can share the screen at a certain time. So if you guys have anything you want to share, I've got our bio pitch deck pulled up. We can, I've got our 2 investment summaries also ready to go. If we want to talk about, here's some of the current performing properties, and then the track. I guess we could go off of this too, for kind of break down our current portfolio.
Okay.
I know we want to talk about our current portfolio, kind of what we've seen this year with our portfolio, what we've seen in the market, what we expect the second half of this year to shape up, kind of issues with commercial properties, different asset classes, multifamily, commercial real estate in specific. We could talk about obviously office, what markets we're seeing across different markets. Obviously Houston, it's a market we're involved in pretty frequently, but we're also in Dallas. A class in Dallas, C class in Dallas varies. Houston A class varies to Houston C class. Obviously we're not investing in California and New York, but we're seeing some of those areas get hit pretty hard across all asset types. Then I think we're going to talk about our criteria for new deals, what we're really focused on. We'll talk about some current and upcoming investment opportunities for investors that kind of pairs into this, and leave it up for Q&A. And I think we'll leave it open too for Q&A throughout too. So if you guys have questions while we're addressing a certain topic, definitely put those in there. Last time we got questions both in the Zoom and on Facebook, so I'll be trying to monitor both of those.
Yeah, this is the first time we do this type of format, so bear with us a little bit here.
Yeah, usually on these we'll have a featured speaker, but for this one we wanted to open it up.
Yeah, I say probably kick it off, man.
All right. Great, Daniel, already kicking it off here. Good afternoon, gentlemen. I'll be at the gathering on Thursday. I look forward to meeting you. I have an off-market deal to let you know about in Florida. Awesome. Appreciate that, Daniel. Yeah, we have the Elevate monthly meetup in Dallas. If you guys are in Dallas, make sure to check out our website. We have all our events here on the website, elevatecig.com/events. So that would be our multifamily meetup this Thursday. If you guys are in Dallas, we have a monthly meetup in the Dallas area on lunch meetup. This will be at District Dallas. So it'll be a new location from last one's. And Justin mentioned there, we are on the hunt for new deals. We'll talk about kind of what kind of deals we're looking at on the tail end of this webinar. And Justin is our director of acquisitions. So make sure to send any deals to him. We're happy to take a look. I'll give a we can do a quick rundown of Elevate. You want? So you guys know us, may or may not know us. So this is the Elevate team, George and Eric, co-founders, CEO, COO. Joel being our asset manager, Justin, our director of acquisitions, myself, chief investments officer. So you guys can find out this on Elevate's website, but this is about us here. We are vertically integrated, so we have about 5,000 units currently across our portfolio. We'll be talking about that portfolio here. We have Elevate Real Estate Management, so we're strategically bringing that on. Right now, they Elevate Property Management. We just brought on property management in-house last year, so part of the market, what we've seen, one of the reasons why Elevate got started in the first place was George and Eric. They saw they weren't getting this full service they wanted from contractors, so they opened up their own construction company. From there, that construction company levered into what is now Elevate after they leveraged that there. So we're kind of doing the same thing with Elevate Real Estate Management. We've taken over our full Dallas portfolio, so our asset in Weatherford, A-class asset in Weatherford, a development project in Irving, Texas, and a C-class property in Mesquite, Texas. So across the board there, we're rolling it out in South Dakota too. We have about 420 units in South Dakota. Not many people are familiar with that market, but that's something that we have a lot of experience in. We're looking at bringing that in-house to Northwest Arkansas. So strategically bringing out property management across our portfolio is something we're looking at as we look towards the tail end of 2023, how we can bring on property management across our portfolio there in the best way. Property management isn't a very profitable profitable business for us. It's more to complement our syndication company and to have control over those assets and bring that on. And then obviously we have J&T Construction, which George oversees, and is a huge help for our construction on our multifamily projects. So we've mobilized them to South Carolina, here in Northwest Arkansas. We're planning on using them in South Dakota, one of our new acquisitions there. So that's how we are vertically integrated. Here's some reviews. Here's what our current footprint is. You can see South Dakota, Oklahoma, Dallas and Houston, Northwest Arkansas. Justin is here in Indianapolis. We are looking at deals in Lexington and Cincinnati, Columbia, South Carolina, and Jacksonville, Florida. Our last three acquisitions were Domain at Morgan's Landing, A-class property in LaPorte, Texas. This is southeast of Houston. We also closed on our Jacksonville portfolio in December of last year, shortly after this. And then our most recent acquisition was Watercolors in Northwest Arkansas, Centerton. So this was A-class property. We closed phase 1 and 2 January, and we're closing phase 3 here in a couple weeks. So this was a two-part closing. This was our only acquisition to date in 2023. So that can kind of tell you a little bit about the market, what we're seeing right now. Here's some of our current portfolio. Story Hill, Lone Oak, Oklahoma. Sophia, and some of these other ones in Texas. I'll leave it to you guys. If you guys, George and Justin, if you guys want to talk about maybe if we want to go into our current portfolio, or I think that'd be a good next step. And then after our current portfolio, we can look at what our acquisition targets are for this coming year.
Yeah, I can talk about some of that. So as far as our current portfolio, we've been, like Brian mentioned, we haven't had a ton of acquisitions this year. So we've been working a lot on positioning our portfolio, whether it's right now we're working on refinances. We exited some properties last year that, we had positioned nicely. So taking advantage of, started off as a I guess a rocky year to the market, but we were able to exit a few deals. And then as far as the ones that we're refinancing, we're just positioning them so that we can begin to ride the market up and exit those deals. And then making sure that we've had to do a lot of adjusting and flexibility on some of the business plans and just kind of adjusting with the market. One thing that we started the in-house management, started working on it early last year. We saw this market changing and we knew it would be nice to have control of the management. Same we did with the construction, just allows us to be a lot more flexible and move quickly. So that's, turned out to be great so far. The assets that we are managing in-house are performing really, really well. We're looking forward to taking over more of them as we continue to grow that side of things. I guess I can kind of go over a little bit of the market we're in, what we're seeing, and then what we think the outlook is. So I guess before I do that, I don't know if Justin, I don't know if you had some KPIs that I know we kind of talked about that yesterday. Not sure if you put something together for the current portfolio.
Yeah, I think the current summary sheet, just like a one pager. Did you want me to share that?
Do you have that one, Brian?
I do, yeah.
That might be easier versus me trying to go through this long list.
Yep.
Yeah, so you can see, some of the performances here. Overall, the properties that are performing better for us are the A-class properties, and that's one of the transitions we've kind of made in the last couple of years is going for nicer properties. Not that we won't look at older properties. They just have to have a deep value add to it and be at a low basis for us to get excited about it. Just as you can see here, watercolors, that's an A-class deal, performing really well. We're continuing to increase the NOI, increase the rents there. We haven't had much issue doing that. Same thing with Morgan's Landing, same thing with Lone Oak. And, we do have, just looking at this list, so where's Town East? Yeah, so Town East, so that's Elevated Town East. You know, this is one that we took over from a third-party management company, and they were not doing a good job. We had a ton of delinquency, and the occupancy was coming down, and we took over it. I can't remember exactly when. I want to say it was late last
November,
year
just-
or early.
Yeah, November, I think.
Yeah.
Or December.
And so right now we've got it at 95% occupied, and delinquency continues to come down. Just night and day. Just goes to show, you know, what good management can do, and staying on top of that. And then, you know, some of our C class stuff has Sophia's doing really well. Trying to break a little bit higher than it's been sitting at 90% occupied. I've been trying to break that, but the NOI continues to climb month on month. And then do have a couple C class properties that have been a headache. One looks like we're going to be exiting actually, and gonna have a projected a decent exit on there. We're able to position it correctly, and we'll be kind of happy to get out of that one. And I think our investors will be happy as well with the returns they get. So yeah, just putting more focus towards the A class, like I mentioned. And then, you know, as far as the struggles, essentially it's been the rates rising, right? So anybody with an adjustable bridge loan has seen their debt service just increase dramatically. Something that probably none of the operators underwrote for before the rates started doing what they did. And then there's those that either didn't have rate caps or their rate caps have expired. Those are kind of the properties that are seeing the struggles, just because their debt service is increasing so much. And if the rate cap isn't there, then it's not even being capped, right? You know, right now, the Fed did pause raising the rates, and hopefully they don't go back to that, but we're not 100% sure. So we've been, like I mentioned, we've got a lot of refinances in play right now. We're trying to get as much as we can into the agency loans. We can still get into a pretty good rate. You know, I think with the acquisition that Brian mentioned that we have in South Dakota, we're going to be somewhere in a 5.5. I think this morning it would have been closer to a 5.4 if we were to lock it in with where the Treasury was at. But you know, that's still a pretty decent rate. And I think we wanted to cover some different asset types. You want to get into that, or do you guys want to say something else about the portfolio and where we're at in the market right now?
Yeah. Yeah. And I think, you know, obviously I think C class, we are the most hesitant about, you know, moving forward as we're looking at acquisitions, just because those have been the largest headache. But I think it really also depends on the market you're looking at. So we have C class property in Dallas that's performing pretty well, you know, really well actually. And this Columbia, South Carolina project that was built in 1970. So technically that is C class. You know, it almost looks and performs like a B class, but that's performing really well. You know, so C class Houston, we're a little bit hesitant right now with the extra legwork that we're having to do there. You know, we like A class a lot in different markets, especially we're looking at just markets altogether. I think Dallas, South Dakota, Northwest Arkansas, those are our top performing markets that we're seeing a lot of growth and, you know, focus on. So as far as markets there, those are really ones we're looking at.
That's a good point on, it kind of depends on the market as well. But I mean, just for example, Ovation, it is C class, but it's actually like one of the best performing assets in the portfolio, just is, metric wise. We've been at or above projections pretty much since acquisition. So it is C class, but performing extremely well. Watercolor, just for a reference, kind of going back to why we're targeting more newer product, better quality tenants, better quality assets. So for watercolors, looking at it now, for the month of April, there was 0% bad debt, which is pretty much unheard of in, multifamily in general, but just like really speaks to the, quality of residents that, live in that community, live in that market. And another note, 99% of the tenants for the month of April paid before the 5th of the month, so their rent wasn't late. So just like really speaks to the, quality of residents living there.
That's right. Northwest Arkansas, guys. That's where I'm sitting right here. So great resident. And looks like we're actually getting some questions coming through. So Daniel asked older than 1990. So I'm not sure, Daniel, if that's as far as targets or what our current portfolio is, but
And that might
Yeah,
be
I
like,
mean,
what are we shying away from? I would say, yeah, probably older than 1990.
yeah, I mean, you see, yeah, watercolors are newest acquisition, and the two we're getting ready to roll out are new properties as well. Like Justin mentioned, not to say we won't buy C class. We have in-house construction. So we can handle it, but we're definitely very cautious about it.
I just
Osman
haven't
had a
seen the
question.
pricing come down enough to make the C class attractive to want to go after it.
Exactly. Yep. We've seen the expectations from sellers, remain super high. And that can be, part of our next segue here. I mean, we're sitting in June 20th and we have 2 new deals, but other than that, we haven't had any new deals to put out since watercolors, which technically was a January closing. And we geared that up last year. So yeah, Justin's been sending about an LOI or 2 a week at least since January. So that's quite a few, but we have to remain strict to our underwriting. When we've seen a lot of syndicators and investors really push it, in 2021 and 2022, but now is the time to be making sure we're picky about which deals we're actually doing. Osman asked, with rates being so high, are you shifting straight to agency on value add deals?
Yeah, I mean, mainly agency is what we look at first. We size up the agency and that's what we would prefer to go in with on an acquisition. We can, if it's a heavy value add deal and you're putting a lot of renovations into it, it's going to be tough for that to size up. So, I mean, we're not scared of taking on a bridge loan. We're going to make sure that, one, there are some bridge loans we can get out there that are fixed. If that makes sense. We'll go that route. If we have to go with an adjustable rate, we're definitely going to try to get a decent rate cap in there, just to make sure that the Fed can't control, what we're paying monthly. And then next question there was, with insurance rates a problem in coastal cities, are you focusing on these areas still or more inland areas? More inland areas. I mean, it's tough when you get to anything that's on the coast or near water, period. It's making it really hard for it to pencil with the insurance rates in those areas. So yeah, mainly inland.
Yeah, I mean, we'd love to do deals in Florida, but yeah, the insurance definitely makes it harder to do deals there. Even something we're looking at in Houston too.
Yeah, we want to try to eliminate as many expenses that we can't really control, which insurance is one of them, taxes is another one. So anything we can do there to kind of mitigate that risk.
Great question so far. Yeah, I guess that can kind of lead us to our acquisition targets, what we're looking at. I mentioned we're sending out a lot of LOIs, but we're just now launching two new deals. You guys have seen one of those. We can kind of talk about that here in a minute. But Justin, do you want to kind of quick recap on what we're looking for in new deals?
As far as just like deal criteria.
Yeah, I guess general deal criteria, what markets we like a lot or looking for or open for, what kind of asset classes we're looking at.
Yeah, I mean, A and B plus assets located in, major metro areas, nothing, and, small tertiary markets, like really like high growth, Dallas, Northwest Arkansas, Florida markets, places like that. Preferably 1990 or newer with some value add component to it as well.
Yeah, and I think, that leaves a lot on the table, and we're pretty open to markets. We haven't done any deals in the, Justin has done some smaller on his own personal portfolio, but we haven't done any deals in the Midwest, but we're looking at that market. We haven't done any deals in Tennessee necessarily, but we like that area. Rapid City, South Dakota, 150,000 population. So under the secondary, I guess, tertiary market definition, but an area where we own already, and has seen a ton of growth. Northwest Arkansas, I guess that's considered secondary at a 500,000 population. We're here and seeing a lot of growth there too. So we are open to looking at different markets if there's a good, growth story there. Asset types, Justin mentioned A class and B plus. We're doing a lot directly from developers. So our past, besides the Jacksonville redevelopment, our past two deals have been past three deals have been directly from developers. You look at Lone Oak, you look at Morgan's Landing and Watercolors, all direct from developer buys. We're now looking at making strategic partnerships with developers where we can get involved with them on the ground up side, to be able to offer our investors to get in on those kind of projects. Obviously, that's something to factor in, as there's, some more risk factor there because you have that construction element, of 2 years of, no really cash flow as you build it and start getting it leased up. But then you have the upside of getting involved on the ground up side. So something we're looking at offering to our investors, and something we've been strategically trying to get in more of with how we've been buying from developers. That could lead us, we could touch briefly on I don't know if we wanted to talk about any other asset types. You guys have seen a lot of, office space has getting a lot of headlines right now, especially in California. Twitter, all these large companies are, cutting their office space in half. A lot of them people are now working from home. The office space has seen its valuations cut in half. So another reason why we're very focused on multifamily and only buying multifamily right now. Retail, still hurting in some areas, and I think that's depending on what kind of retail. So brick and mortar stores, restaurants in some areas are doing well, but you do see, typical retail that are hurting. Where if someone can buy it online, they're usually buying it now. We're more of an e-commerce click society, so we're seeing some aspects of retail hurting. But as we're looking at the development projects, we have looked at mixed use development when the multifamily component is the majority of the component. So we'll look at some mixed use component if it's primarily multifamily, and maybe pair it with a restaurant or a couple retail spaces. Some cities will actually make you do that on the development side. Industrial has slowed down in certain areas. So that's kind of what we're seeing across the market. Multifamily fundamentals are still strong. Less people buying homes, more people renting, more people not necessarily being able to afford their dream home with interest rates at 8%. They still want to live in a nice place. So hence the market study for A-class properties. A lot of people are working from home and not necessarily ready to buy their dream home. You have a lot of people wanting to travel now still too. So they may work for a company for 1 to 3 years and move to that location and want a nice area, nice apartment to live in, where they don't necessarily want to be tied down to a home. So we're seeing more and more case study for A-class new developments there.
Got a couple questions come in, Brian. So how are things with your Jacksonville property? So actually, I was just there last week, checking on it. I mean, project is going extremely well. Timeline is on point. They're moving along. We're pretty much done with all the roughs, the rough electrical, rough plumbing. And the next step we'll be putting up drywall pretty soon. So things are moving nicely. That market is only getting stronger for the type of units we're putting up. So the rents continue to go up. We went and checked on one of the comps, and when we looked at it originally, they were asking for around 1,100, 1,150 or so, and right now they're asking for 1,300 for the same units. So yeah, that project is going well, and we're excited about it. Next question here was, have you guys seen any conversions from retail into multifamily storage or anything else? So seen a lot of hotel to multifamily, right? That's being thrown at us on a weekly basis, different projects, especially since we closed those in Jacksonville. We're taking it slow. We don't want to spread ourselves too thin on those type of projects just because it's a lot of resources. We'll definitely do more of those. Just, we'll take it a little bit slower on how many of those we're going to do. And then I'm definitely seeing some office to multifamily. I'm not entirely opposed to doing those type of projects. You just got to be able to come in at a really low basis, because you're going to put a ton of work into it, even more than your hotel to multi, because you're pretty much framing everything out. You're having to run, with the plumbing in our current project where we're taking the hotel to multifamily. We're just tying into the existing plumbing that's in each unit. An office, I mean, you're going to have to run quite a bit more plumbing, because it's not like it's split up into the units like they are here. So yeah, just more work. You're going to have to come in a lot cheaper on your acquisition to make those pencil. And then as far as retail to multi, I personally have not seen that. I have heard of storage, taking some retail and turning it into storage. I haven't seen it, but I have heard of that happening. But yeah, I mean, there's offices, 50-something% occupied right now. So, I mean, I think that one's probably hurting the most from real estate right now is office space. Yeah, that's why we like the multifamily. I mean, like Brian said, the fundamentals are still strong there. They're going to continue to be strong. Yeah.
For sure. Yeah. And I think depends on the market for those conversions. And it is a huge management intensive project and it has some element of risk, but I think there's some strategy there. So we can talk a little bit about our two new deals. If we want, unless you guys had something else you wanted to hit here. Because we
I'm sure
talked a little bit of
Did Justin go over the criteria we're looking for on deals?
A class and B, I mean, kind of broadly, A class
Okay.
and B plus properties, major metros. You know, we
That's
will
right. That's
look
right.
at.
And then you started talking about, a lot of the straight to developer, that kind of stuff. Yeah. 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 I mean, I think we can jump into the new deals.
Yeah, and so, with that being said, which one should we look at first?
Go with Stony Creek.
So,
Let me answer
Not gonna-
Daniel real quick before you get into that. So Daniel's asking, will you consider self-storage acquisition? I would say from all the different asset classes we mentioned there, which we didn't really mention storage much, that's probably the one we're the most open to is storage. I don't know if we'd look at just a storage project, maybe.
yeah, not a target, you know. Something I have in my personal portfolio, I have some storage units kind of bought off market, small in my backyard. Pretty much, I'm selling those right now to recapitalize and put those into our existing project. So I have stuff storage that does okay, does fine, but I'm going to actually sell those so I can have more capital for our multifamily projects coming up. But it's not one of Elevate's targets.
Maybe it's like located like right by multifamily property we had, like a self-storage property. That might make
Yeah, I
more
think-
sense.
Yeah, if it's in a market, yeah, exactly. If it's right next to a apartment that we own currently, we're building storage units on our last acquisition in Watercolors in Northwest Arkansas. So it has existing storage units and garages, and we're actually building additional storage units on that property.
Yeah, the demand is high, that's for sure, especially in our A-class properties. Our garages are always occupied, and then our storage units always run a high occupancy. So definitely a high demand for storage.
Garages, storage units, carports, all great items for extra income on our new A-class properties. When underwriting, what percentage of the asking price is a good indication to go into a deep dive? 80 to 85% is what Justin said. That's like the discount.
I think what he's saying is if you underwrite something and it pencils at 80 to 85% of what they're asking, then you should go into a deep dive. Anything under that,
Okay.
then
Yeah. And I would always let them know your feedback. Yeah, this wouldn't work for me, or this works for me at this price.
yeah, I would say submit offers. I mean, before when the market was extremely hot, I was saying if we're not close, forget it. But right now in this market, it's kind of submit and follow up. That's how you end up getting some good deals.
Yeah, for sure.
And like really quick, just want to touch on this, like a common, we're talking like a lot about A-class, but a common criticism of A-class is, like in recessions or like uncertain times like we're in now, like you'll see people magically move out of the A-class properties and into the B-class. So are you guys seeing that on the news, in your portfolio, hearing that from other operators, or are you guys seeing or hearing that happen right
Nah,
now?
not seeing it, not hearing it. you can maybe argue we're not in a recession or deep recession, but I don't know. I mean, the type of deals that, at least the ones we're acquiring, you know, it's not A plus. Well, some of them, at least the amenities are, but you know, the rents aren't at the A plus type where essentially it's where somebody's going to go before they go to B class, and to me, going from an A class to a B class is a pretty big jump that most people don't want to do.
Yeah, and it depends what market you're into. I think, are there a lot of jobs going to that market? If there's a heavy job growth, you're going to be getting more and more employers going to that area. If it's the job growth is kind of flatlining, you probably won't have as higher demand for. You can look at population growth, but job growth, I think, is an even bigger indicator too of demand for A-class properties when you have more and more high white collar income earners in the area, and they're going to be paying for that. You might have someone that wants that top of the market product. So depends on the market again too.
Are you want to do a quick summary of Stony Creek?
Yeah. So speaking of, high population growth, high job growth, direct from developer buys, that's exactly what we're doing here on our newest acquisition, Stony Creek in Rapid City, South Dakota. I'm going to put the link. Whoa, Siri. Okay. I'm going to put the link to we're going to have a webinar for this particular deal. I'll put this in the chat where we'll go on a deep dive for this asset. So 278 units in Rapid City, South Dakota, A-class 2008 build from the original developer. So this property you can see right here sits on about 27.5 acres, really cool property in Rapid City that we're buying from the developer. We've actually bought from this developer before. We bought this property right here, La Crosse Estates, a C-class property in Rapid City, 15 minutes from Stony Creek. This developer does really well on he's a known builder in the area for taking a lot of pride in his work and his ownership. He built this property in 2008, and he's had it since he built it in 2008. Take really good care of the grounds, really good care of the property. We're bringing a lot of the property management on site onto the property. We have really good debt lined up. We talked a little bit about debt on this webinar. So we have fixed rate. It's going to be a 7-year fixed rate, interest only. George mentioned it right now. If we rate lock today, it'd be about 5.4. We're expecting to rate lock anywhere between 5.4 and 5.6 interest. So that'll be fixed for 7 years. We'll pay 7 years interest only. That's going to be a Freddie Mac loan, HUD loan, or a Freddie Mac agency loan. So, talking about preservation of capital, that's one of the best ways right there. We have, like I mentioned, over 400 units in the South Dakota market. This property in particular has about $150 to $200 delta between what the developer is currently renting it and the market comparables are. This property, what's really cool about this, Justin mentioned it on watercolors, but this property here has been sitting at 99.5, just under 99.5% occupied, with less than 1% of that bad debt. So we sent this to a couple pref equity groups. So the pref equity comes in, they write a large check, and they get a certain preferred return. So our investors on this deal, if they're investing 100,000, 8% preferred return, 500K, 10%, and then you get the 70-30 split up until your IRR hurdle, then 50-50. So the preferred the pref equity comes in and they get just a preferred return, no upside participation. One of the pref equity groups said, they look at tons of deals from operators all day, just as many as we do, and actual deals that are under contract, and they hadn't seen anything like this as far as physical occupancy and bad debt. So 99.5% for 2 years, you can definitely, that's a good indicator that you can push rents right there. Just looking at, if you just looked at nothing but that on paper, you'd be able to see that there's a good story to push rents. Pretty light renovation here, $1 million budgeted for CapEx. And then I put, we're actually closing this July 24th. So about almost 30 days from next week. We're scheduled to close then. So we have opened this up for funding. We've already had 14.5, if you include our pref equity, we've had $14.5 million committed. It's going to be a total $19 million raise. So we have about $4.5 million left. So a lot of interest quickly. I think the biggest hurdle for you guys or for our investors is South Dakota, getting everybody comfortable with South Dakota. So this is an awesome asset. We're buying directly from the developer. The numbers are terrific. We're getting fixed rate debt. But, a lot of people aren't as familiar with Rapid City, South Dakota. So I think that would even be higher than 70% filled on the investor front. So South Dakota, I'll talk a little bit about South Dakota. South Dakota was one of the only states to not shut down during COVID. So they are super business friendly. A lot of businesses are starting to gravitate there. They saw that happen during COVID, and those conversations started, and we're seeing those kind of facilitate in Rapid City specifically. You have Mount Rushmore in Rapid City. So, the touristy area, Badlands, in particular for Rapid City is, a lot of growth happening there when you look at the city level. But South Dakota has seen a ton of growth. And then within Rapid City, we're seeing even more growth right here. Fastest growing area in the Midwest. Right here, you can look at some of the Rapid City indicators. 1.9% unemployment rate. That's actually a U.S. history low. We're seeing kind of population growth here. Vacancy 1 to 2%. Just if you look at a citywide vacancy, we looked at some other developments in the area, and they are full just as quickly as they built them. So really cool submarket, about 150,000 population right now. Something else, the Air Force Base there, they signed on the B-21 bomber. So if you are to fly a B-21 bomber, you have to train in Rapid City. So they're expecting about $1 billion economic impact within the next 15 to 20 years. So a lot of those people for the Air Force, they have to go somewhere to go spend their money, and Rapid City is that city where they go. So you can see some of the different employers in the area. Black Hills Corporation, that's who I pay my utilities to. They've got a huge corporate facility right next to this site. So I don't know if you guys have anything else to add on this, but you guys definitely are invited to the webinar that is this Thursday at 6 p.m. where we'll be going on a deep dive for this project. We've got 10 minutes left. I will quickly jump over to our next project that will be rolling out after Stony Creek. So you guys are the first ones to be seeing this, for being signed up on our newsletters and in our Facebook group. This is our next project that will be rolling out. It is a ground up project here in Bentonville. We haven't released this yet. This will be 236 units. We talked about buying from developers. This one, we're actually going to be partnering with a developer on a ground up. This is in Bentonville, Arkansas. So you guys probably started getting familiar with Northwest Arkansas on our last acquisition, Watercolors. This was our last one. This one is less than about 5 miles from this property. I actually am about 5 miles from the development project as well. It's a mile and a half from Walmart's new, I think we might have that here. Yeah, Walmart's new home campus. It's about $1 billion. It is $1 billion, $1 billion home campus that they're trying to rival Apple and Google. So Northwest Arkansas just made it to the top 100 metro, about 520,000 population. Here it is situated on the map here. So really cool project. We'll be breaking ground in August on this one. So it'll have about two years of construction and then 3 years of stabilization. We're looking at a 5 to 7 year hold here. So I'm really excited to be starting this one too. So this is just a quick glimpse, and you can always email me for more information on this one, brian@elevatecig.com. So yeah, those are our 2 new acquisitions. It's we're already halfway through the year, and finally got two really good ones. We're excited to start rolling out. So we expect both of those to fill very quickly. Obviously, rolling out Stony Creek, we're already 75% subscribed. We haven't really marketed about that subscription, what we have left. So about 4.5 million of the total 19 million raised there. So definitely encourage you guys to get in on this one. I think this is a great one. I'll be investing personally on this one. It's a great one when you're looking at your investment as a whole to diversify your portfolio. I think it's a great way to diversify in a steady growing market. South Dakota, good fixed rate debt. That's a really good hedge against inflation and good place to clip some coupons. The preferred return on this one, something we haven't. I think that's also another reason why we're getting a lot of interest too. We have an 8% preferred return and a 10% preferred return for 2 different share classes. Usually we start out at 6% preferred return, but we did this just because we know there's some hesitancy with South Dakota. So we wanted to incentivize you guys to invest with us in South Dakota, give you guys an extra layer of protection there on the capital stack. So excited to be launching both these deals are really great ones that all of us will be investing personally in. So
we got a nice comment there from Brandon. Says, I'm local here in Rapid City. I can definitely attest to the property being a killer project. One of the nicest properties in a great area of the city. We did not pay Brandon anything to say that.
Yeah, thanks, Brandon. Appreciate that. Yeah, exactly. And that's one of my, as a CIO, I wanted to go out here. Yeah, it's a 2008 build, and you see some other properties being built in 2018, 2019, but they were quickly put up. No offense to those developers, but they didn't really need to do a lot to it. There's such a demand for A-class properties and rentals in Rapid City. They're just throwing these apartments up, and a lot of them have these kind of hotel feel to them. It doesn't feel like a real community like Stony Creek does. It sits on this giant 27.5 acreage where it's a really cool feel. Like if I'm a resident in South Dakota, this is one of the reasons why I'm living in South. You get a nice panoramic view of the Black Hills, and really have that community feel. And this is just with classic interiors. This is not even with upgraded units, so we can do some nice upgrades on the interiors and really steamroll on this one. And yeah, Brandon, actually, I think we're meeting our one of our equity partners up there possibly as soon as next week. We'll see what everybody's schedule looks like, but they want to get out there quick. So we'll have to hit you up when we're in the area. We've got about 5 minutes left. If you guys have any kind of questions, comments, anything about what we talked about today, any of their 2 new deals we've got coming up, happy to discuss any of that. Have you touched base on interest rates already?
I mean, we said a few things on interest rates, but
Yeah, we talked a little bit about that. Actually, on our last webinar, we actually had Larry Wildman with Walker and Dunlap, talk about interest rates. So that's something we're very, conscious of. I think interest rates are where they're going to be. Maybe another hike, maybe 25, 50 points. It's hard to have a crystal ball, but as far as underwriting, we're underwriting for increases. I think as operators and as acquisition guys, we're hoping for them to stay where they are. And I think, if I had to put money on it, I would think they'd be pretty close to where they're at for the next year or so before they start coming down again.
I agree. I think it's going to stay flat for a bit. Hopefully the data that continues to roll out shows that inflation is getting under control, and they just leave it flat. And then, sometime next year you can possibly expect for the rates to start going down. But like Brian said, I don't got that crystal ball.
But for underwriting, we are projecting them to increase.
Sure.
Definitely not putting any lower decreases in our underwriting. But yeah, that's great. Well, I appreciate you guys coming on. Again, we put the link for our webinar on Thursday. We'll be doing a deep dive on our current opportunity, Stony Creek. You can come in there whether you plan on investing, see how we look at deals. I don't think this one be around for much longer, and then we'll be rolling out our Bentonville project shortly as well. So yeah.
Yeah, appreciate everybody that got on and solid questions. Thank you.
Thanks.